All right, everyone. It's a slim crowd today, but the show must go on. All right. One of the things that we're going to talk about today, I sent out a poll last week as to what is it that I should cover today. And I got a resounding yes for stocks. And so today, one of the things we're going to look at is stocks, right? Now, one of the things that I want to touch on coming from last week where we spoke about credit cards. Today, I went ahead and I got my credit card statement. And this is now about 7 months, getting close to a year in with the credit card. And I've yet to have any statement with interest payments or finance charges on there, right? Because as we spoke about before, one of the things to be a deadbeat is to pay often and to pay early. So that's what I do, right? So I'll go ahead and make a purchase. After a few purchases, I go ahead and make a payment on the credit card. What that does is just eliminates whatever interest was trying to accrue in the back end. So when it's time for the bill to be paid, there's no interest. So I just wanted to touch on that real quick because I just got my statement like yesterday, right? So let us head on over. We are going to cover stocks and shares. They're one and the same, and many people use them interchangeably, right? So some people say the stocks, some people say the shares. They're one and the same, right? So the first thing is, what is a stock, right? Everybody says they want to get into stocks, but do they really understand what is a stock? Well, what a stock is you have part ownership of a company. That's it. So if you purchase a stock of Seprat or you purchase a stock of GameStop, you're actually purchasing a piece of the company. So you are sharing ownership of that company. Now, one of the things with that is when you hear sharing ownership of the company, you say, does that mean that they're going to lose control of the company? No. They normally, when companies list shares, they only list enough that even if somebody was to come and buy all of the shares, they still would not have a majority of the company, right? So it's just something to protect them from essentially hostile takeover. But that is what a stock / share is. It is just part ownership within a company, a firm, or whatever is listing those shares, right? Now, when you talk about stocks, everyone talks about the stocks that are on the stock market because that is what is in everybody's face. That's what's on the news. However, there are two real types of stocks out there. You have preference shares and common stock, right? Now, the common stock is the stock that everyone knows about, right? Preference shares, however, don't they get listed, but it's not made as public, and it usually is a lot more expensive to get preference shares. And as we move on, you will see why. And companies generally don't list as many preference shares as much. You may find preference shares with like financial institutions and those things, but as far as a company coming out and listing preference shares, no, you might not see that too often. Common stock, as I said, is the one that just about everyone knows. Anytime you're watching TV and they're talking about shares, they're referring to common stock. So what are preference shares? Well, the first thing is preference shares is a hybrid between common stock and a bond, right? What happens is that it carries some of the benefits of the common stock that everybody runs down, as well as some of the safety aspects of a bond. So, normally whenever people want to go ahead and be real safe with their investments, they go ahead and purchase bonds. And when people want that gain and want a lot of equity in their investments, they go more for stock. Well, preference shares carries a little bit of both. As I said, it has a higher growth potential than a bond, but less than a common stock. As I said, you're finding that middle ground when you're using a preference share. So it's not going to move like a bond. A bond generally barely even moves. Like you're going in really just for the income from a bond. Common stock, a lot of times you're going in for that equity growth. Yes, some of them may pay dividends and so forth, but your main thing is, oh, I'm going into this stock and I'm hoping that it shoots straight to the moon, right? But with preference shares, it doesn't grow as fast. So you're not going to get the whole to the moon, but then in the same breath, you're not going to be as stagnant as with a bond. The other thing, and this is the reason, this is why it's called preference shares, is because when it comes on to paying dividends, you have higher preference than common stockholders. So let us say I have preference shares in Bank of Nova Scotia. When it comes time for them to pay dividends, they're going to pay me first. Now, whatever is left, that's what the common shareholders will get. So sometimes when you hear companies come out and they say, oh, we can't issue any dividends, that doesn't mean nobody got dividends. It just means that a lot of times by the time they go ahead and pay the interest that they have to pay on their bonds, and then they go ahead and pay the dividends that they're going to pay on their preference shares, there's nothing left. And so who doesn't get anything? Common stockholders, right? Common stockholders is the bottom of the pile when it comes on to payouts, right? So that's really where the name preference came from, is you have preference over common stockholders. Finally, one of the things in regards to this is that it's a steady, like I said, because it's preference shares and your preference over common stocks, it tends to be a steadier flow of income than common stock. So even if you have a common stock and you say, oh, this is a fantastic dividend stock, they're still paying their preference shares before they pay you. So if at any moment in time after they've paid off their preference shares, they're going to cut you. They're going to say, oh, for the next 2 months, 3 months, no dividends. And you're thinking, oh, well, nobody's getting any love. No, the bondholders and the preference shareholders are still getting theirs. So like with a bond where you're going in primarily to get income, that's the primary focus with a preference share as well, is that you're going in for the income. The only benefit here is that with the preference shares, you also get a little bit of equity growth as time goes on. Now, what is a common stock, right? This is the thing. This is GameStop. This is most of the stocks that you see listed on the stock exchange. It's common stock, right? Common stock, much higher potential for growth. There's no ceiling on the growth. As much as the company grows, you're going to grow along with it, right? The example just about everybody uses when they're talking about the stock market is Amazon and Google. Those who went in, bought them at almost little or nothing and rode it straight up to where most of them are now millionaires, right? And in some cases, some of them are billionaires. So when you go ahead and buy a common stock, your growth rate is exponential. So for example, we said bonds is flat. Preference shares is a slight curve. Common stock, that curve can be almost vertical depending. I mean, look at even Last year with COVID, when it started to go ahead and started to have the recovery, look at Tesla, look at a lot of those other companies that increased over 200% over the year. Your stock, boom. Preference, if those companies had preference shares, they wouldn't have seen 235% return. They might have seen 60%, right? But they're happy with that because they don't have as much risk as with common stockholders. Another thing is that you have voting rights, right? You actually have a say within the company. Now, out here in Jamaica, you see it a lot more in your face. It is called an annual general meeting. And every company has to hold an annual general meeting, right? Now, the annual general meeting essentially presents the matters of the company to you, the shareholder, right? So when you go ahead and you have your shares and you see a prospectus come in the mail, you see something come in the mail, it's because you are a common shareholder and you have voting rights, right? So you can, when it comes on to determining who's going to be the board of directors and those things, you have the power to do that, right? Do many of us exercise that? No. Why? We only care about to the moon. But you have those who will go to the meetings, who are very diligent and will actually exercise their rights. The other thing, as I said, it's the most commonly traded stock on every stock exchange. So when you're hearing about, we had covered meme stocks, those are common stocks. When you're hearing about how Tesla stocks shot up, those are common stocks. When you hear about how well Jamaica Broilers is doing, how well Froshrich is doing, those are common stocks, right? So normally when people talking about shares, yes, nobody's going to be all technical and say, oh, I bought 50 common stock of this, but that is the technical thing, right? The other thing, as I was saying, bonds safe, preference shares, a little growth, mostly safe. Common stock is you're riding with the company in its good, you're also riding with the company in its bad, right? You have many people who go ahead, get inside a company and they're like, yes, I'm going to ride this company out. When the company is doing good, you see them clapping their hands, everything. And one bad thing comes out about the company. And now when they look in the stock portfolio, there's nothing there. It's worthless. You know, this happened a lot during the financial crisis of 2008. And this is why a lot of people who were set to retire now have to go and work again because they were common stockholders. And so when you started having the financial crisis, their shares plummeted, right? Now, with a preference shares, this is something to note with preference shares as well as bonds. Like with the financial crisis, you had companies that liquidated. Now, during a liquidation, you know, you have your creditors that you have to pay. They're coming front and center. Well, the first people that come in are actually their bondholders. They have to get back their money. The next people in line is preference shareholders. So all that dividends that they had accrued for you, you are up there in line to get that money if they're liquidating, right? The last in line that falls after everybody else is common shareholders, right? So that is why when your stock reach down to nothing, you just have nothing to show. It's because the company has liquidated and they don't have any money to pay you. But they've paid their preference shares, they've paid their bondholders, and they've paid their other creditors. So that was just something that I thought I should know. All right. Now, you're saying with all of this, I want to start investing, but why should I choose stocks? Well, as I said, stocks, you ride with the company. So what does that mean? you have a greater, you get greater returns on your investment, right? Now, you hear the horror stories, you also hear the fantastic stories. So you hear the Googles, you hear of the stocks that have plummeted and those things, but in the middle, stocks go up, right? Over time, stocks go up, right? So just about any investment that you make, if it's not a crap company, it's going to go up over time, right? And so you're going to get the return on your investment. It's just how long it's going to take. And that depends on the investment that you've made. The other thing is you can go ahead and you can get stocks that suit what your needs. So if you're looking for stocks that are going to carry high equity, you can go into those. It's just that a lot of times those tend not to pay dividends. And on the flip side, you can pick stocks that don't have that high equity behind them, but then pay a strong dividends, right? And then you also can have one that has a mixture. It won't grow as much. It might not have a great dividends, but it's doing both. So it's going up over time and you're also getting dividends. So as I said, there's stocks out there based off of what you want. So it really boils down to what you want. The other thing is, like I said, because of that volatility, you're able to literally be part of the company, right? In both its good times as well as its bad, right? Now, many people tend to sell off and tell the company goodbye during the bad times, but you do have those that anticipate that there will be more good times and they'll stay for the ride. You, as I said, you have the ability to earn income while increasing the value of your money. So it's essentially that stock that I said that you have the mixture where it's growing, not as fast, but it also has some dividends. So your equity is growing as well as you're receiving dividend payments, usually each quarter. Now, how can you choose to grow your wealth through stocks, right? So I'm hammering these things so that you guys get the concept here. You have equity growth, right? Equity growth is growth purely by the stock's value. You buy a stock for $10, tomorrow the stock is worth $20, you have $10 worth of equity. That's it. You also have income growth, whereby, what is it everybody usually say? Reinvest your dividends. That's income growth. What you're doing is, if this stock goes ahead and it's giving $10, so you bought the stock for $10, you receive $10 worth of dividends, which would be fantastic, right? But with that ratio, right? You receive $10 worth of dividends. You now have $20 of stock, but the stock's value did not change from $10, but now you have $20. That's income growth, okay? So those are the two. So don't get it mixed up. If your stock goes up in value on its own, that's equity. If the stock is going up in value, essentially your portfolio, not the stock, your portfolio balance is going up without the stock value actually moving, then that is income growth, all right? Now, stocks moves with the times, right? You always have to watch out with the stocks, right? The stock market on a whole is a moving target. It's not a static thing, right? So what is it that you have to do? Well, as I said, stocks move with the times, and there are different sectors that benefit at different times, right? This is why I say it moves. You know, 1 minute the banking sector is really hot, then the next minute it's the energy sector. So you really have to stay on top of it, right? One of the things, these are some of the things to look for, as I said, with the changing times. What causes these fluctuations? What causes a sector that used to be strong now weak, and a sector that used to be weak now strong? Well, one of the main things is change in management. We see it all the time. There's a huge price movement when it comes down to stocks when they go ahead and change CEO, right? You will hear that this CEO, just the other day, Comcast stock plummeted just off of the news that their CEO was looking at offers from Viacom CBS. They were just the news that he was just looking, and the stock price plummeted, right? If they like a CEO and they hear that the CEO is leaving, stock price goes down, right? Now, it's like even out here, right? But even in Jamaica, what you will find is with companies, if you find that there's a change in management and it is a manager that a lot of people aren't too favorable, you're going to see movement in the stock market, right? So change in management tends to move the price. Another thing, mergers, right? Mergers usually drives up the stock that needs the benefit as much. So let us say AT&T stock is trading at $50 and AT&T goes ahead and purchases a little mom and pop and decides to merge them. The mom and pop stock is going to fly through the roof. AT&T stock might not move as much, but the mom and pop stock is going to fly through the roof because the mom and pop is the one that's going to actually benefit the most from this merger. So that's another price movement. Inflation, right? We also saw it. When inflation goes up, stocks go down, right? So you have to watch for your inflation. The moment that you see inflation on a rise, especially if it's going to be doing large jumps, you need to start looking at your portfolio and start planning accordingly, because there are going to be stocks that's going to start to fall. Changing government or policies, right? Now, you usually in every country, there tends to be a government that is very favorable to corporations and a government that is not so favorable to corporations, right? When the party that is favorable to corporations are in power, you tend to see the stock market go up. When there's a change, you tend to see the stock market do a shock at first because they're all crying because that means more regulation might be coming their way. But over time, it usually builds up again. But that initial shock, changing government. They come up with a new policy. They say that they're going to increase the tax rate from 25% to 35%. Boom, big movement, right? Because who are you impacting the most in that situation? Corporations. Anything that impacts corporations impacts the stock market, right? Now, one of the last things I want to touch on is something that you normally hear about, and everybody likes to talk about it, and it is such a fancy thing to talk about, right? Or I just went ahead and I purchased this IPO, and I was looking in and I was thinking about getting into some IPOs. All right, you need to know what is an IPO. It's not that special, okay? An IPO is initial public offering. What that means, I have a company, I want to list it on the stock market. The process of listing it and essentially doing the first mode of trading is the initial public offering. That's it. That's it. It's not anything all that, right? Now, other thing to note is it's usually not available to everybody, right? So when you hear that a stock is going to be listed on the stock exchange on Monday, that means more than likely on Friday, they're going to issue the IPO to their select group, right? Now, the select group goes ahead and they're doing the initial bidding, right? So let us say they they say a stock is supposed to be valued at $50. During the IPO, the special group went ahead, bidded it, pushed it up to $70. Well, they purchased it for $50. When you get it, it's at $70. You rush it and push it up to $100. Now you only filled a $30 gap. They filled a $50 gap. And that's why a lot of times after an IPO release, you will see the stock shoot up and then instantly come out, because a lot of people go into IPOs to make money off of that initial shoot. But in the same breath, everything that comes with a big reward, big risk. We always talk about that. Now you have stocks that go ahead and they push up the IPO, that same IPO that they went ahead, push from 50 up to 70. A lot of people say, no, it's not worth the 70, right? What happens to it? Boom, it drops down to 10. You bought it at 50. So now you have a $40 per share loss. So it's a gamble that you take, right? The other thing with IPOs, there's no historical data to base it on. This is the first time that they're going onto the stock exchange. So you cannot look at how did they perform last year, what's their track record of their returns. You don't have a list of financials that you can look at. No, what you receive is what they call a prospectus. A prospectus usually has some form of financial information, usually what they intend on doing with the money that they receive from the stocks, and a little bit about the company, right? So it's really based off of your analysis and a lot of times it's your gut on whether or not you think that this company is going to do well on the long term, right? So in brief, that is what an IPO is, right? So in conclusion, what is it that you need to do? First, do not make emotional decisions when picking a stock, right? Don't just pick a stock because, oh, I like this place. You don't know anything else about it, but the customer service is nice. No. And the same breath, don't sell a stock off of emotion. Oh, it did a big price movement. There's nothing wrong with the company, but because it did a big price movement, you're all emotional and then you sell with a loss, right? I've done that a couple of times and I regret it every time. So no, don't do that. The other thing is you have what is called fundamentals and technical analysis, right? And in later sessions, we'll deep dive into those, but it's important for you to know both the fundamentals of a company as well as the technical analysis of that company when deciding whether or not to invest in that company. Keep to your values, right? Don't just go in just chasing money. Stay true to who you are. You have people who are going ahead and investing in only Black-owned companies. You have those that's investing only in green energy because that's their values. That's what they stand for, and they're supporting what they stand for. Remember, whichever company purchased the stock, you are now part of that company. So that company's values still reflects on you, right? Other thing, invest in what you know. Like, I don't invest in any fashion. I don't know fashion, right? I don't go ahead and invest in pharmaceuticals. I don't know pharmaceuticals. I invest in what I know. I invest in the things where when I'm reading up on it on the news and so forth, their terms make sense to me. That's what I invest in, right? And I'd mentioned news. The last thing is follow the news. You start investing, you need to know what is going on each day, not only with the company, but with the economic climate, not only the economic climate in your country, but the global economy. And you start to piece together how is that now going to impact you, right? In the beginning, it might seem very big scheme, but after a while, you start to see, because you read the news and you hear that somebody made this decision, and by that evening, you see a stock move. And you realize, oh, it's that decision that happened, and that decision could have even happened in another country. And you see a stock move based off of that decision. So follow the news. Don't stay insulated. You have to be very global when you're looking at it. So that's the end of the presentation for this week. As I said, we're going to continue on the topic of stocks, because this was just an introduction, and stocks carry a lot of terms and a lot of things that when you're going to go ahead and try and decide which stock you should invest in, it's really important that you nail down what are the fundamental terms and what they actually mean and how they could really impact you. All right. So thank you guys for coming out. Be sure to look for this video. I had posted up the credit card video already on my YouTube channel. As I said, go ahead, make sure when you subscribe, hit the notification bell so that in future, whenever I go ahead, because I'm going to start uploading other type of content that isn't covered in the weekly sessions. It's going to be a lot of it. Some of it will be short. So I'm going to try and keep it very interesting. But those I will not talk about during the session. So you'll actually have to look at my YouTube channel in order to see those. So be sure to hit the notification bell on that one. All right. Thank you guys for coming out.